Like many sub-Saharan Africa countries, Kenya's economy saw strong growth in 2010, gaining 5.6% up from 2.9% recorded in 2009. However, expectations for 2011 have somewhat cooled as the country faces multiple challenges on the economic front.
Depreciation of our currency basically affects economic growth in just a couple of ways, basically. One, Kenya being a net importer of most of the goods, you'll find your imports become expensive. When your imports become expensive, it now goes down to the input into production, input into the cost of doing business. And naturally, as industry, they will pass those costs down to the consumer, which will now fuel inflation. So the main cost of a depreciating currency to an economy is that it stagnates growth in real terms. If you measure growth in just monetary terms, it might seem it might have increased, but the aspect of the inflationary aspect of it that it has caused will cause stagnation on real terms.
According to Bloomberg, the Kenya shilling has weakened more than 10% according to the US dollar this year, making it the continent's worst performing currency. This, combined with several other factors, has led the World Bank to cut its estimate for Kenya's economic growth this year to 4.8%, down from an initial estimate of 5.3%.
4.8% growth for Kenya is still very good, and Kenya started the decade on a positive note at about 5.6% growth for 2010. We continue to believe that in the medium term, Kenya can achieve and sustain growth at about 6% per annum, which would bring per capita income in Kenya to about $1,000 by the end of the decade. By World Bank definitions, that would put Kenya in lower middle income status.
The shilling's weakness, coupled with high inflation, currently at 13%, may further reduce the country's competitiveness.
And look at our economy in terms of how much value added do we have from local resource bases and also from imported materials. A lot of the food and fuel inflation is coming from imported products, and that, with the dip in the shilling, is going to get affected. So believe you me, it's going to be price rises going up again, because once energy goes up, the cost of the dollar does affect all our energy. So fuel, food, all that is going to be imported is going to go up, and that's not going to be good for the economy.
Manufacturers have also warned of further increases in commodity prices as the shilling continues to fall.
Somehow we need to see a balanced view on the exchange rate. I think the PS actually said between 80 and 85 was a good balance. I think that was accepted by the economy, and then we had sort of rationalized it. With this 90 at the shilling, dollar shilling 90, I hope it's reversed quickly, because otherwise there'll be a lot of repricing. And once repricing is done, it's very difficult to sort of have an effect coming down after 3 months.
The country's central bank has shown no signs of intervening, but some analysts feel it should move in to stem the tide.
What the central bank has to do is to just arrest the speculation aspect in this current depreciation of the shilling. Because as much as fundamentally things are also not okay, there's a bit of speculation that is actually fueling the depreciation of the local currency. So it will depreciate slightly, not so much, if the central bank is able to rein in the speculation. There's been a lot of noise in the media about the shilling, which also needs to stop. Because as much as media is making noise on shillings depreciation, it also fuels speculation.
I think the most important thing that the government of Kenya needs to do is ensure that the exchange rate remains competitive, so that the drivers of Kenya's growth, which currently include horticulture, exports, as well as tourism, continue to do well in the global economy.